Housing prices inflating around the world, and what does it mean for you? That's the topic for today's episode, and without further ado, let's dive in. Hello everyone, and welcome back to another episode at NOVARISE Invest. If this is your first time tuning into this channel, let me tell you, this is your channel for real estate education. So welcome back. We're at that time of the month again where we're going to do a full-blown analysis of everything that has been going on in the past month and how that can help you make a better and informed decision in your investments going forward. We actually started doing this at the beginning of 2021, and so far we have gotten tremendous engagement. Everybody seems to be very happy with it, and since you asked, we're going to continue to deliver, and here we are. So without further ado, let's just jump straight into my screen and start off with the very first article that we're going to analyze. And is this one right here that you see about the passing of the 1.9 trillion COVID stimulus. Now, I know this is not new news, right? Everybody seems to know about it, but I wanted to start off our conversation based on this because everything that we're about to analyze, it's going to revolve around everything that has been happening with the pandemic and the stimulus that has been approved lately. So for those who are not fully aware of what's going on, well, let me tell you, for those who know, congratulations, that's great. But let's just try to even out the playing field. So the 1,400 check has already been issued to most people. Expect to see that money via direct deposit into your account unless you file your taxes petitioning the refund to be sent to your address. But for the most part, most people are receiving a direct deposit of the $1,400 stimulus. So that's one thing. And as we scroll down in this article, which, by the way, I'm going to leave you the link down below. You're more than welcome to check that out. But I just want to go ahead and focus on one thing that I find it's going to be really important that we do remember throughout our analysis today. So the legislation also provides $7.5 billion for vaccine distribution, $48 billion for testing and contract tracing effort, $22 billion for rental assistance, and $39 billion for child care, $29 billion for the restaurant industry, very important, and more than $160 billion for schools and universities. So remember these amounts because we are going to eventually come back to it, right? So this sets out the foundation for our discussion, and what we're going to do is move on to the next article right here. So as you know, I've been mentioned it before, it is no surprise that the houses are inflated. Housing prices are ridiculously expensive, but it's not just in the US. So as you can see in this article, they are inflated around the world. So this is not the only country, and it has to do with the pandemic related stimulus, as you can see here, right? So aside from the pandemic stimulus, we also have ultra low rates and changes in buyer behavior are fueling, turbocharging the markets from Europe and Asia. So there's been a migration, you know that, right? So there are a lot of people migrating from the metropolitan cities where there's lack of space, where everybody is basically on top of each other, and they're just simply migrating into areas where there's more space, more bedrooms for their family members, call it husband, call it wife, call it children, and at the same time, more fresh air, right? What that created was just simply more demands and area where they weren't accustomed to that demand. And so it created a ripple effect, and where housing prices in the cities started to decrease because there was less demand of it and more people were actually moving out. And that started creating a high demand and a people who are willing to pay over the asking market price because they were in need of a property. So because of everything that was happening in COVID, obviously construction slowed down. The construction materials also gotten expensive, which is a point that we're going to get to in a minute. But basically, people just wanted to get a hold of the house and did not care about paying over market price because they're buying with their emotions. These are homeowners, not real estate investors. Real estate investors, they buy with numbers, but homeowners do buy with emotions, right? So what that created, it's inflation, right? So home prices continue to rise over time. And for those who are brand new to this channel or don't understand the concept of inflation because you're just basically new to financial literacy, I would like to provide you an example, once again, to level out the playing field. So inflation means things getting more expensive. So let's say, for example, you make, I don't know, $10 an hour, and you are accustomed to a certain lifestyle with whatever you can afford with $10 an hour. But then all of a sudden you go out to restaurants, you go grocery shopping, and the rent everything becomes a lot more expensive. So whatever amount of money you used to make per hour, it's going to allow you to buy less of what you could normally afford. And that means decreasing the quality of your existing lifestyle, right? So that's in essence what inflation means. But back to this article, I want to go over some of the statistics so you can actually see what this article talks about. So let me see. As the U.S. Housing market booms, a parallel rise in residential real estate prices across the world from Amsterdam to Auckland is raising fears of possible bubbles and prompting some governments to intervene to prevent the markets from overheating. So it sounds very familiar, very similar to what happened back in 2008, but with a bit of a twist, right? So what's happening right now, right? Let's just start off with today because, there's no time like the present. So today we are getting a ridiculous demand on housing, right? We already know why. But there's also the existence of a cheap money, right? So even though the lending has tightened up, the rates are low. So people are taking more risks. People don't want to miss out on the cheap money, and they want to take that money either to buy more real estate or just simply reinvest it in their homes, right? What happened in 2008? So in 2008, we didn't have cheap money. What we did have was easy money. So basically anybody could have become a real estate investor. All you got to do was just to walk up to a bank and say, hey, I make $1 million a year. And the bank is not going to verify that. They're not going to ask for your tax returns or anything to verify or to confirm that you do in fact make the amount of money that you're claiming that you're making. And so what that led to was just easy lending, and your credit was not even an issue at the time, because if your credit was low, that means the banks get to charge more interest rate, which means more money for them, right? So people without the experience, people without the knowledge started to, they became real estate investors. They didn't have the expertise nor the discipline to manage money, let alone manage a real estate portfolio. And over time, just like everything, because of the easy availability of money, there was FOMO, right? Fear of missing out. More and more people started buying houses, which was fueling the housing prices, and everything just became more expensive, and eventually the bubble burst. And there's a high possibility that something like that could happen today if, the government, according to this article, doesn't take any action. So just so you can see that it is not something that it only happens in the U.S. It happens worldwide. Anything that happens in the U.S. has an impact worldwide. We live in a globalized economy, and there's no such thing as a segregated country that only suffers separately. Everyone is impacted depending on what they do with their money and depending on what they choose to invest their money at. So there is one point in here that I wanted to call out, the statistic. I found it to be very interesting. And it's here. So in China, regulators have tried taping down property markets to cool what one senior banking official referred to as a bubble, to little avail. Property prices are up 16% over the past year in the city of Shenzhen, for example. And in New Zealand, median prices for homes are climbing 23% in February from a year earlier. So, and as you go on to the article, they call out the psychological effect that it creates, that this situation is creating on people, because as houses continue to go up in prices, people take more risk, right? People take more risk because they are willing to pay for an expensive house because I better get it now before it becomes more expensive. That psychology applies for people who are looking to buy, but those who are currently owning a property, they feel richer, right? They feel that their net worth is actually growing up and up because, hey, I am sitting in this house, it continues to appreciate, everybody is willing to pay for more. Why don't I take out on a loan, take a little bit of more risk, because money is cheap nowadays, and use that money and renovate my kitchen, renovate the pool, or maybe create a nice home office since everybody's working from home now, and just ump up the value of my property. So what we don't know is what could happen tomorrow, right? Depending on the circumstances. But the truth of the matter is, we don't know if those houses are going to continue to go up in price, just like it did happen in 2008, right? People thought that the market was going to continue to go up, and they never stopped to think that, hey, eventually what goes up could come down. And this is a possibility here. So more people are taking on risk. They are renovating their properties, are paying more money for their houses, and not knowing that eventually, hey, maybe the housing prices could stagnate, could stop growing in value, and possibly having another 2008 repeating all over again. Again, it's a little too soon to tell that. Last year, I did mention that within a couple of months, if things continue to go down that route, if no vaccine was discovered, and if people continue to work from home, and there continue to be a demand for bigger properties, that, a burst could happen. But now we're seeing that the presence of a new stimulus and the presence of the vaccine could start changing what we originally anticipating. So we have yet to know what exactly could happen down the road, and all we have left to do is just to continue to monitor. At the same time, this article talks about the widening of the gap, right? Because now we're talking about people who are rich, who manage to get richer now because of the increase in their assets, their houses, their real estate. They feel richer. They are richer on paper. But now we have these families at the bottom of the pyramid who could be in a situation where they were barely getting by. So now these families are becoming poorer because their salaries are not increased. Inflation is kicking in. Things are more expensive, and let alone, having accessibility to buy a home. So they're getting poorer and poorer. The houses are getting more expensive, and that American dream will continue to be a far, far, far American dream that they could possibly ever reach. So it's just funny how the scenario it's playing out. There are a lot of similarities to 2008, and this is definitely something that you should be on the lookout for, just to see what could unfold out of this situation. And because we talked about the stimulus, we talked about the inflation and housing prices, and we talked about the vaccine distribution, let's just talk about New York and see what's happening right now, right? So why am I bringing up New York, right? You might wonder. Well, fairly simple. In prior episodes, I talked about the migration. I talked about the economical decrease of some of the areas, the metropolitan areas, because more and more people did not want to be in cities. They did not want to be locked down in tiny little apartments, of expensive apartments, and they didn't want to be in the epicenter of what everything was going on, right? So New York was actually the epicenter of COVID cases, and which is normal usually in big cities because of the concentration of people. There's a lot of working class people who don't have the luxury to just simply work from home, right? They had to go out there. People who work in restaurants, people who are working in the delivery industry, they have to put themselves out there and get themselves exposed, right? And so for a year, whoever was residing in New York in one of their tiny little apartments with 4 other roommates or 4 other family members, they were forced to actually move out, either moved in with their parents or any other family member who had a bigger house in the suburbs, or maybe perhaps even buy or rent out in the suburbs, just to sort of like weigh out what was happening. But now things are starting to get back to normal. The vaccine is available. More people are feeling more comfortable coming out, and schools are reopening. So now we have a mix of virtual classes and classroom classes where students get to go to the school. So now these families are actually forced to, not forced, but they have the option to want to come back now. And that's exactly what's happening in these bigger cities. So for those who were monitoring the metropolitan market, you might have noticed that the housing prices did go down roughly about, I would say, depending on the area, I would say between 5 to 20%. But if you happen to be waiting for the market prices to go down a little bit more, you might want to rethink that, because as you see in these articles, families are coming back and they're looking to buy larger spaces. So if you were waiting out for that right time, I think this is the right time now, before the prices start picking up again and they go back to pre-pandemic digits, and take advantage of the relatively low prices today. Now, because real estate is very versatile, buying homes is not the only way to go about it. Having rentals is not the only way to go about it. We also have the flippers who, want to buy properties, ugly ones, fix it up, make it pretty, and then just sell it out in the open market and making a profit out of it. So if you, at some point, you thought that New York was dead or the major cities were dead, well, think again, because now you can come back and continue to do what you're best at and what you know what to do. So this article talks about what exactly these families are looking for. So they're looking to come back, but this time they're looking for bigger spaces, which is the complete opposite of what, things used to be. Most people wanted, bunk beds and maximize the space that they got because they want to maximize their money. But now they're looking for bigger properties because some companies are giving their employees the opportunity to work from home. It just happens that these employees, they don't want to work thousands of miles away. They want to stay in New York and they need the space. So there's a higher demand for 3-bedroom or 4-bedroom apartments. Another thing that has changed is that they want to have proximity to parks as opposed to the subway. Before, if you are a New Yorker by nature, if you didn't know, properties that are closer to the train, they tend to be more expensive because it's a faster commute. Then you can just hop on the train and get to work. Now it seems that the train is not much of an issue now. People want to have proximity to the parks because they want the ability to take their kids over there and have fun and play with them and stuff like that. So definitely a great article for you to consider. Now, another article which talks about the contrast of it is remote working and how it has impacted smaller cities or smaller towns, right? I've been saying over and over, there's a big migration of people, going into smaller cities. In fact, last week I actually released an episode of smaller cities who will pay you to actually move there. And what that did is just shift the opportunities. It shifted the opportunities that normally back in pre-pandemic era used to sit just in major metropolitan cities. We're talking about Boston, we're talking about New York, San Francisco. Now, even though it might seem like there has been a decay in the economy, I will say that there was just simply a shift. New York is not dead as far as I'm aware, and my sister just came back from LA and things to be pretty nice out there. I think what simply happened is just there has been a reshuffle. Now New Yorkers or people who live in major cities, they can breathe now. There's still people there, but now they're not on top of each other. Traffic is actually bearable now, but the city's not dead. The economy is still there. And what happens with that migration, with that reshaping, is that now some smaller cities are enjoying the opportunity that they couldn't have enjoyed before. Now they're attracting young professionals. They're attracting people with degrees who are willing to buy homes, who are willing to rent there because they have the opportunity to work from home. And that creates what? It creates opportunities for small businesses as well. It creates opportunities for a new local library, for a local shop, for a local coffee shop, for local restaurants, which means it's created an opportunity for you as a real estate investor as well, because now you get to have the opportunity to provide housing for those who are looking to rent, for those who are flippers. Well, now you have the opportunity to, build homes and make those readily available for people who are looking to buy. Same thing for commercial spaces, right? People are looking to have a nightlife, have a life in general outside of their houses. They don't want to just be locked down, right? Because they're used to the metropolitan life, to the fast-paced life, only they don't mind having it a little bit slowed down, a smaller area. So this article, in essence, just talks about that. It talks about the people who truly enjoy working from home and they want to continue to have that opportunity as that new way of living. And these are the cities that they're mentioning that are catering to that as well. And in addition to that, they're also giving you a credit to move in. So this article, along with the one that I discussed in my prior episode, are definitely good starting points if you're actually considering to either move out of major metropolitan areas, or maybe you're considering investing in real estate in some of those areas because you just want to explore new stuff out there, right? At the same time, revolving around the pandemic, there also is a sudden demand for office spaces because, once again, yes, working from home is great. There are a lot of people that enjoy that, but there's some other people who don't really necessarily enjoy that. Some people love having that interaction with others, love the chit-chatting, loving that coffee break, loving that conversation with their coworker, and they don't necessarily want to be locked down at home. Maybe they got through a divorce, and I'm not saying this is a joke. In fact, 2020 was the year with the highest divorce rate possible. Think about relationships that have been stumbling across, but just because they managed to stay busy, they lasted. But you take two people who are not getting along with each other, and all of a sudden you place them in the same house, in the same apartment 24/7. That's a recipe for disaster. So maybe whoever is going through that, they don't want to work from home. They want to have the opportunity to go out and feel better, right, and interact with others. So this article talks about the booming again, if you can call it that, of the office space. So the office space is not entirely dead. So for those who manage to tap into the opportunity to invest in office spaces, now this is your chance to basically provide that space and maximize your investment to the next level, right? So as you scroll down, you will see some statistics here. I'm not going to read it all. You can definitely check out this article on your own. But let's see. While Seattle experienced seasonal declines in Q4 2020, demand is now up to 182.6% in 2021. And then if you look down, we also have California Two California markets, we have San Francisco, who was down 5%, and Los Angeles, that was down 18%, have almost regained their losses since the beginning of the pandemic. So a very good article for you to check out, and it's nice to get this contrast. So I like to think that in spite of the unfortunate situation, that the pandemic has created opportunities, right? It created an opportunity to allow big cities to breathe, to reduce the amount of people that was in there, to reduce pollution, and give a way to those smaller cities to thrive, to prove themselves that, hey, we can also compete against the major cities, because not everyone wants to have a fast-paced life. Maybe they want some components of it, like the ability to go out and eat out, to go to movies, hang out in a coffee shop, but they don't necessarily want to be rushed like this all the time. And then for those who wanted to remain in the office space, hey, you can also have that available for you. So it's kind of like the best of both worlds, right? Now, moving along, since we talked about inflation, we talked about the lack of availability for housing, mainly because there's no construction materials available. I wanted to talk about this article because there is another reason why housing prices continue to go up, and it has to do with the prices of lumber, wood, bricks, or anything that's related to construction materials. So now we have a lot of demand. We have unavailability of construction materials. And on top of that, if you manage to get a hold of construction materials, they happen to be very expensive, which in essence, it translates to the high cost of housing available in the market. Now, for those who are dedicating themselves to do house flipping, it's not the end of the world. Yes, it kind of sucks because things are getting more expensive now, but everything makes up for it, so to speak, right? Because why? Even though you're getting materials at a higher price, you can also sell your property at a higher price because, hey, consumers, home buyers are willing to pay more just so they can have a place for them to call home. So in spite of everything that is going on, it's still a very profitable market for you to actually get in. Look at this. American Homes for Rent, which built more than 1,600 rentals last year and plans to construct another 2,000 houses this year, said its lumber bill, it's between 20,000 and 25,000 per house, up about 10,000. Fortunately, we have been in a rental rate growing environment, and that has kept us yield neutral. So meaning it's still profitable in spite of the high cost of the construction materials. And moving along, let's just talk about land, because land has also have experienced an increase in prices, so to speak, mainly because of China. China is coming back strong after the pandemic, and it's competing against U.S. farmers. So if you happen to own any farmland, this is your opportunity to take advantage of this situation, either selling that land or just simply renting it out to the farmers out there. So this is definitely a great article for you to check out if you happen to own land. So now moving along, let's talk about Texas, right? I know a lot of you are probably sick and tired of hearing about Texas, but this is important for your investment because the country and the world did not realize how much they were depending on Texas. So Texas freeze triggers global plastic shortage, right? And what does it mean for you as a real estate investor? So the construction industry, it's highly dependent on plastic, right? So once again, we're going back to what we were saying. If materials are not available for the market, that means it's going to take you longer to be able to supply houses to the market where demand is actually going off the roof. And this situation doesn't only impact home builders, it impacts hospitals, which need these plastics for, the disposal of toxic materials and stuff like that. And also even the automobile industry. I mean, think about Tesla, who had to stop productions for 2 weeks just because they didn't have power in their plant. And now you add to that the fact that there's a shortage in plastic available. What do you think is going to happen to production? And Tesla's not the only one that's been impacted. We have Honda, we have Toyota right here. Definitely something for you to keep in mind in your decision making process. Now, moving along, let's talk about Alabama. Let's see what's happening in Alabama. For those who are following the news, you already know, but for those who don't know, Alabama has been recently hit by tornadoes, and as you can see, the picture is not pretty, right? So add that to the pandemic, add that to like everything that's going on with COVID, with the economy, the slowdown, and now this, right? Now, the reason why I want to bring this up is because a couple of years ago, I actually talked about an article about disaster investors, right? And so that episode actually created some controversy because of the ethical component of it. So for those who missed that episode, and for those who haven't seen this article, the article talks about disaster investors. There's no other way to call it. So disaster investors basically do this. They come in, they seek for natural disasters in certain areas, and they come in and they invest in the area. So they buy the houses from the homeowners at basically pennies in exchange of them taking over and just revitalizing the area. So they're buying the houses, they're buying the land, houses that are the insurance are probably not covering, or houses from homeowners who did not have insurance and are just basically left homeless, but they also don't have the money to repair those properties. So these disaster investors, they come in, they buy the properties, they fix it, and then they either sell it or they help revitalize the area, whatever is it that you call it. So when the episode was released, it sort of like created controversy in the sense that the room was actually split half and half. So half of the people who tuned into the episode, they found that to be completely unethical. How could you live off of other people's misery? And they're left without a home, and yada yada. The other side of the equation were people who were pro disaster investors. Why? Because let's just face it. Homeowners, they did not have the money. They were left without a home, yes, but at least they were able to get some money so they can start a new life elsewhere. This is one of the arguments that one of the subscribers made, right? And at the same time, sometimes the states, they don't have the budget. They don't have the budget because they have to deal with the school system, they have to deal with highways, they have to deal with the pandemic and everything that's going on with the economy today. And they just maybe don't have the resources to tackle one more disaster that's happening. So instead, what they do is that they work on attracting real estate investors who come in with their expertise and their willingness to help revitalize the area, to pick up, everything that was broken, as you can see in this picture, clean it up, and then just reinvest and build the economy from the ground up without the government necessarily having to intervene with that. And then as they build everything back up, they get to tax these real estate investors. That means revenue for the state and more revenue for public schools, public parks, and stuff like that. And then it's a win-win situation at the end of the day, because in order for the investors to be willing to do that, they also have to make money off of it, because at the end it's business. So it was a very interesting conversation. There were a lot of comments going back and forth, and I just thought that as soon as I saw what happened in Alabama, that this will be something interesting to bring up again for you guys to actually check out. I'm going to leave the article down here so you can actually read it in your own time. So now, moving along, right? So let's just talk about the rentals and what's happening with landlords, right? But before we do that, I want to remind you that if you are enjoying this episode, I wanted to ask you to please don't forget to hit the like button down here at the bottom so you can help this episode rank and help other people like you who are looking for this kind of information. And if you happen to know somebody who could find use or help with this episode, feel free to share the love and send this episode their way so they can actually stay informed and make the best decision possible. So back to this article, let's just talk about what's happening with rentals, with the eviction process, and the landlord. So as you recall at the beginning, I actually talked about this paragraph right here, and where the stimulus package is issuing $22 billion for rental assistance. So this rental assistance is meant to help tenants who lost their jobs, who have been furloughed, you name it, to get access to assistance so they can continue to pay rent and not left homeless. So interesting enough, what's happening here is that there are some landlords out there who are actually not willing to accept that rental assistance for many reasons. So one of them is the fact that those assistance programs have too many strings attached. It requires them to disclose their financial statements and things that they, under regular circumstances, they're not willing to disclose. One thing about real estate investors is that we want to ensure our anonymity, and tapping into those funds means giving up our anonymity. And that's one thing that it's extremely important for real estate investors to consider. Another issue right here is the fact that they might be dealing with troubled tenants. Let's just face it, this is a pandemic. Everybody loses in this situation, right? There is a tenant who truly needs the money, who truly doesn't have the resources available to continue to pay the rent, but then unfortunately they wind up on the street, right? Because at the end of the day, they couldn't keep up with the lease. But there are others out there who are milking the system. There are other tenants out there who just simply, they do not want to work. They know how to milk the system. They don't want to pay the rent for the landlord. And on top of that, they're destroying the property. Those are the troubled tenants. Those are the troubled tenants that the Israeli investors don't want, because they just simply want to get rid of them. And if accepting that rental assistance means the inability to get rid of them, that is something that they definitely do not want to deal with. So a very interesting article. I'm going to leave it here for you to check out. And what we're going to do now is just to move on next for diversification. But before we do that, I know I've got a couple of comments from you guys wanting to learn about real estate and how to, just do the proper research and see what's the right price to pay for a property and how to maximize your investments and stuff like that. If that's you, I'm going to leave a link down below right here. And that link will basically allow you to register to a free webinar where you are going to be able to learn how to invest in real estate the right way, right? How to make the right investment right from the get-go so you don't have to stress out at the beginning and still have enough to continue expanding your real estate portfolio. So for this, you're going to need at least about 2.5 hours. Make sure you have a working pen and paper so you can take lots and lots of notes and no distractions whatsoever. So the link is down here below. Feel free to check it out, sign up for it. It's completely free. You don't have to worry about paying anything. There's no deposit that you have to make. So just simply check it out. So now move along. Let's just talk about taxes. I'm pretty sure some of you already know this. And for those who are not looking forward to pay taxes, well, I have a great news for you. May 17th is now the new deadline for you to file your taxes. And this article has everything that you need to know for you to understand what does it mean for you in terms of deadlines. Okay, so now moving along, and let's just talk about diversification, right? Because we talked about ways to complement your real estate investment with other alternative assets. So here, we're going to talk about the electric vehicles, right? So in the analysis that I did last month, I did talk about how the Biden administration offer a lot of incentive to invest in electric vehicles, and how electric vehicle in itself was one way for you to diversify your investment. And I particularly talked about Tesla, right? And a lot of you enjoyed the episode, so I really appreciate the comments and the feedback and the interaction. But at the same time, some did mention that investing in Tesla could be a little bit too pricey. Some of them did not think it was worthy of your investment, and that's completely fine. This is a free country. And that same article and that same video, I also talked about investing in Lucid Motors as a way to diversify away from Tesla. So for those who haven't heard from Lucid, it's basically the luxury version of Tesla. It promised to deliver a higher battery life, better quality in cars. But the truth of the matter is that Lucid is still not in the market. So the way they are traded publicly is through a SPAC. And so when I talked about the SPAC, there was a lot of controversy going on, and a lot of people did not like the idea of investing in a SPAC. So what that led me to do was just simply, continue to look for other alternative ways for people who still want to have a footprint in their portfolio. For those who still ways to diversify their portfolio and still have, something related to the electric vehicle. So what I found was this article right here that talks about Ford, GM, and Volkswagen tapping into the electric vehicle mania, right? And as you scroll down, this is actually very interesting because Tesla dominates the electric vehicle market. But now what this chart did is that they compare how Tesla looked and the automobile industry in comparison to all these other brands, Volkswagen, Mitsubishi, GM, and Ford. And they're actually a very, very, very tiny little portion of the market share, right? Now, keep in mind that Tesla, the reason why Tesla looks like this is because they're only competing in the electric vehicle space. Meanwhile, Volkswagen, we're talking about, the regular traditional cars that we've always been familiarized with. But now these brands are actually coming up with electric vehicles in and in itself. So why am I sharing this with you? Well, in the event that you did not like this SPAC, in the event that you did not agree with me that Tesla was worthy of your investment, or maybe you thought it was too expensive, Volkswagen and Mitsubishi and all of these companies are one option for you to consider. Because if you see here, the price of Ford, it's only $12.14 in comparison to Tesla, which is in fact, pricey compared to what you saw before. We also have Volkswagen stock price right here, and it's only $34.65. So definitely a great way for you to diversify. I'm going to leave the article down here in the description box below for you to check it out. Okay, so very interesting, and let's move along. In my last analysis, I also talked about the semiconductor business, and I also have news for you about Intel. So Intel is actually investing $20 billion in a new US chip-making plants as part of the turnaround plan. Now, if you missed last month's episode, when I did this analysis, I just wanted to sort of like help you tie everything together. Why are semiconductors so important? We live in a new era where electric vehicles seem to be the new thing, and also working remotely seems to be the new thing, right? And what happens when you work remotely? You have higher demands for electric devices. You need more cell phones, and you need more laptops. Maybe you need more iPads because you're working from home. You need more storage devices for you to store information, yada yada. So that has driven up the prices of the stocks that produce semiconductors. So that includes AMD, that includes Taiwan Semiconductors, a manufacturing company, TSM. More and more companies are going to make a bigger use of semiconductors because that's just simply the way our lives are headed towards. So Intel did not want to miss out on the competition, so they decided to invest $20 billion and just tap into that market share. So for those who are looking to diversify outside of AMD and any of the, or NVIDIA or any of the other stocks that talk about that specializes in semiconductors, Intel is also one of the options, and I'm going to leave the article right here. And to expand that a little bit and sort of like bring it back to real estate, I wanted to share this article with you as well, because Intel, yes, it is investing $20 billion, but they're investing it in Arizona in their manufacturing campus. So where exactly in Arizona? We're talking about Chandler, Arizona, right? So if you are looking to provide housing, Chandler is the way to go. If you're looking to provide office spaces, commercial spaces, storage spaces for those who want to work remotely, Chandler, Arizona, it's your way to go. Okay, so fun article, definitely check it out. I'm going to leave it down in the description below. And lastly, we're going to talk about Bitcoin. Now, I mentioned in the past I don't invest in Bitcoin, but it seems to be that this is something that everybody wants to talk about. So why not just share the news for those who are trading on Bitcoin, so that way you know what's about to come, right? So Dalio, right? Who's Dalio? Right here. Billionaire investor Ray Dalio, the founder of the $150 billion hedge fund Bridgewater Associates, the world's largest, made a case that there's a good probability, okay, that Bitcoin could be outlawed, similar to when the U.S. government made it illegal to privately own gold. I mean, that happened not too long ago. Now it's legal to own gold again. But you should be on the lookout of what could happen. And then, I mean, he goes on and on about, the possibility of that happening and why he thinks it could happen, and how government wants to maintain the control, and they don't like a new source of currency or a new sort of money coming in and just taking their power away from them. So very, very interesting article. You should definitely check it out. I think that's pretty much all I have for you today. I know it was quite lengthy, but I wanted to make sure that you have everything you need to make the right decision in your investment, so you can come out as a winner out of it. And while I still have you here, do not forget to check the episode right here, so it can help you complement everything that you have learned today. And once again, friendly reminder, if you're looking to learn how to invest in real estate the right way, don't forget to check out the free webinar, and the link will be down in the description box below, or you can just simply rewind this episode and look it up on the screen. And that's pretty much it. And until then, I'll see you guys next time. Take care. Bye-bye.